Chart patterns. Learning to recognize different Forex and crypto patterns can help with successful trading. Common patterns may indicate the need to buy or sell, and understanding them takes time and effort. What are trade patterns? Identifying patterns in the Forex or crypto markets can help traders understand trends, reversals and volatility. Increasing pattern recognition skills is key to making advantageous trades. Quite simply, a trade pattern is formed by at least two trend lines, which may be straight or curved. Traders use the patterns of a currency or crypto's price fluctuation over time to predict its future movement. Who uses trade patterns? Technical analysis traders use chart patterns to decide when to buy and sell currency or cryptocurrency. Professional traders can use chart patterns to make predictions, but some mean more than others. Each different type of pattern is broken up into two categories. The two main patterns consist of continuation and reversal patterns. Let's take a quick look at what each type indicates. Continuation patterns are used by many traders to indicate when it is a good time to buy Forex or crypto, as they usually suggest the current trend will continue after brief consolidation. Reversal patterns indicate that a trend is likely to change, and are useful for buying or selling crypto or currencies. Here are 4 popular patterns to look for. One type of chart pattern you should be aware of is the triangle. Triangle patterns indicate a continuation of an existing trend. There are 3 main types of triangle patterns: descending, symmetrical and ascending triangles. A triangle is known as an ascending or descending triangle based on the price trend. Ascending triangles are identified by a flat upper line of resistance and a rising lower trend line. Descending triangles are exactly the opposite. Generally, on a downward trajectory, their relatively flat bottom and falling top trendline distinguish them. Symmetrical triangles stand out from the other triangle designs, as they are commonly regarded as bilateral figures. They are made up of resistance and support lines that form a symmetry when drawn. They can indicate bullish or bearish breakouts and indicate uncertainty in the market. What about reversal patterns? Reversal patterns are important to recognize in price pattern recognition, as they indicate when a trend is likely to change. Head and shoulder patterns are reliable reversal trading patterns made up of a large central peak with 2 smaller peaks on either side. The inverse of a head and shoulders pattern is exactly the opposite, where there is a large valley in the middle, flanked by a smaller one on each side. The double top or double bottom reversal pattern commonly forms during trending markets when the current trend hits a maximum or minimum, rebounds to either of the support, resistance lines, touches the peak, valley again and then reverses direction. Some traders hedge their bets by setting their pattern recognition software to place orders after a pattern forms. But professional trading pattern recognition algorithms will weigh more than one pattern when advising whether one should open or close trades. Trading in Forex and cryptocurrencies requires a sharp eye for patterns, yet no pattern is guaranteed to be successful. Don't invest money you can't afford to lose. For a comprehensive, multi-level analysis, invest in an advanced trading algorithm like Chart Prime. Let this powerful tool reveal hidden insights, giving you the ability to craft smarter trades and expand your profits.